All right, let's bring in our aforementioned guest. For more on the Chinese consumer and the ripple effects, let's bring in Shehzad Qazi. He is Managing Director and COO of China Beige Book. I got to ask you, what is China Beige Book? Because we're familiar with the U.S. Fed's Beige Book. It's not the same. It's not that kind of thing.
It's not the same. We run large-scale business surveys inside China. Thousands of companies are surveyed by us every month, around about 20,000 unique companies a year, which helps us get a pretty good sense of what is actually going on the ground in the world's second largest and most opaque economy.
What happened to Pinduoduo, and can we generalize from its example out more broadly to the Chinese economy? Is something, a tidal change afoot there?
Look, what's happening in China is everybody's having a tough time, right? This much is clear. The reason is that Chinese consumers are not spending money across the board. Now, they spent more last year than was ever acknowledged. This year, what we're seeing is they're spending on things like experiences. So over the summer, they are spending on travel. They are spending on dining out. They're just not going out there and buying another Chanel bag. And even cars and automotive sector are starting to struggle a little bit in China. So it's that dynamic that's at play.
It's not that they're not spending, it's that they're spending differently, what we talked about a little bit earlier. Yeah. There's been a lot of thinking that at some point the Chinese government swoops in to stimulate the economy and get it moving. You see that happening?
No, not in the way that I think the markets have been expecting. First of all, let's establish the fact that the Communist Party is not interested in blowout GDP numbers. They are interested in putting a floor under growth, which means that if they hit something like a 4.9% this year, they will be very happy with it, which means they have no desire to do large-scale stimulus programs the way they did in the past. They want to deleverage with the system, especially property. They want to have something that's far more sustainable if they can get to it. Yeah, big question mark on that. And then they want to get the country ready for the next trade war.
How might a trade war with the United States under a different administration, how might that injure the Chinese economy and these companies that we're talking about?
Yeah, I think it's going to be a big challenge for them, especially because of what they've done in the manufacturing sector. They've doubled down. Chinese overcapacity is a real problem, right? So they are, as a matter of fact, selling as much as they possibly can now before tariffs take a hit. And in a way, that's to cushion the blow, I think, against what's coming next year or the year after.
Tim?
So government should not be subsidizing bad businesses. And in China, bad business has been building too much residential property. I mean, what about letting a lot of these businesses go bad? And if you take down one or two bad banks, you backstop the depositors, you let the banks get crushed. Do you see this happening? Because ultimately, this would be actually, I think, a very encouraging signal to the markets that the government isn't going to just stand in there and not let Darwin kind of win out here.
Yeah, I think they have done that to a certain extent in the property sector with a lot of developers, for sure. And we do see some of that take place in China. It's just it's a recycling of the money, right? So you let some of these banks or some of these asset management companies fail, and then a state bank takes over. The problem is they start doing the same thing over again, the bad loans to zombie companies to keep them alive. The problem is really systemic in nature, and I'm not sure anything will move them away from that practice.
It doesn't sound like you see any real stimulus coming then. In other words, is there any sense that the market is wrong on this? Because that's really where I think the market finds Chinese equities without any white knight to jump in.
Yeah, no big fiscal stimulus is coming in. The housing rescue package is going to remain pretty modest. And here's the other thing no one appreciates. They've done a lot of monetary stimulus. It has just failed to move the needle. Companies are not interested in going out there and borrowing, no matter how low the interest rates keep coming. So the credit transmission mechanism in many ways seems broken, too.
Shehzad, does a weakened China make it more likely for them to do something with Taiwan or less likely, in your opinion?
Look, I think the Taiwan goal is something that Xi's going to do at his own time, and she's going to pick a time when he wants to go in. And I don't know if the economy is going to impact it one way or another, because they could have a weak economy but a very strong military, and they are trying to be as technologically advanced and as strong as they possibly can, even if it means having sub 2.5% GDP growth rate.
When you see what's happening with the consumer there, it feels a lot like what was happening with the U.S. consumer post-COVID, right? I mean, they're getting back to spending. They're wanting to get their savings up. They're moving to experiences over goods. So how much are they just behind the U.S.? Like, are we going to see that same trend in China that we are here? And is that something that we can extrapolate out in the future?
A couple of things are going to make a big difference. Number one is going to be housing. Do we get a housing bottom this year? I remain optimistic that we get, in sales terms, a housing bottom in 2024. The second thing, of course, which will will, unless it changes, is stimulus. We got tons of money being thrown at households in the United States. Nothing of the nature has taken place in China, nor do I think it will. So I think the capacity to spend will always remain much more restrained compared to American households.
To button this off, you say you wouldn't be surprised to see some short-term rally in Chinese equities, but it would not really necessarily signal economic strength. It might signal merely that money needs a place to go.
Yeah, that's a big, it's called a big money ball in China. It used to roll from property into commodities into equities, and properties into hot, and bonds perhaps are a little bit overdone. So it may be making its way over to equities sometime soon. And really, it's a function of having a close capital account. People have to invest somewhere and make some money in the short run if they can.